Hello, everyone. Today we'll be speaking about the significant amendments in taxation laws which has been brought by the budget 23-24. We would be covering few topics. First, on the ITC reversal in case of CSR expenditure, and some significant changes on the customs front, primarily to do with the procedure in relation to trade remedial investigation, timeline for disposal of appeals by settlement commission, and validity period of exemption notification and its applicability for FTAs. I'm joined by my colleague Saurabh Dugar and Akanksha Dikshit, who will be expounding on these two issues. So over to you, Saurabh.
Yeah. So, hello everyone. One of the GST amendments proposed in the Finance Bill 2023 concerns the availability of ITC on CSR expenditure which is done by companies. So, under the GST, while there is a free flow of credit of GST paid on procurements, an exception to this practice is the Section 17(5) of the CGST Act, which specifies the goods and services on which the ITC will not be allowed. So in this very section, the section 17(5), it has been proposed to insert a new clause to the effect that ITC in respect of goods and services which are received by a person, which are used for their CSR obligation, has been restricted. So the broad framework of the CSR expenditure comes from the section 135 of the Companies Act 2013, and along with that Companies CSR Policy Rules 2014. So what section 135 of the Companies Act mandates the company is to ensure that at least 2% of their average net profit is spent towards the CSR activities. So thus the compliance of this is mandatory for any company to which it applies. Accordingly, many taxpayers took the stand that statutorily mandated CSR expenditure was incurred for business, and consequently they were eligible to take its ITC. So this credit eligibility on CSR related procurements has always been a contentious issue. So there are divergent rulings by the authority of advanced ruling under GST. So while on one side of the spectrum, in the advanced ruling in case of Dwarikesh Sugar and Bambino Pasta, a favorable ruling was given for the taxpayers, whereas on the other end of the spectrum, there are negative advance ruling in case of Polycab Wires and Adama India, which said that SSEs are not eligible to claim the ITC on the CSR expenditure which is being done by them. So with the introduction of this new clause, the favorable rulings of the advanced ruling authorities on eligibility of credit related to CSR activities no longer holds good. And this proposition basically is also contrary to certain other ITC restriction under section 17(5), where an exception to legal obligations have been given, such as in case of food and beverages, travel and health related expenses. So also this also significantly impacts the industry, as it inflates their CSR expenditure by the rate of tax applicable on relevant procurements, typically in the range of 12 to 18%, which is the GST rate generally. And thereby the funds which are available with the companies for allocated to actual CSR expenditure will reduce significantly. With this amendment, there are a couple of questions which remain unanswered. For example, it is also possible that some companies may carry CSR activities over and above the de minimis threshold of 2% under section 135. So in such a scenario, would the tax paid on such expenses pertaining to CSR activities exceeding the threshold would be eligible for credit or not is a question. So, and this amendment is also likely to expose various previous ITC claims made by by companies to litigation. So, however, the taxpayers can argue that the specific prospective restriction would mean that ITC was available for the period prior to amendment also. Yeah.
Thank you, Saurabh. It was very good, and the explanation what you offered over it. CSR is something which ideally shouldn't have been restricted because it's a statutory expense, and more so when government is looking to expand the social responsibility of companies. It's a unfortunate cost which is getting added to. Now, to Akanksha, can you elucidate on the customs amendments of significance?
Yes, sir. Thank you. I'll be dealing with the key amendments proposed in the Finance Bill 2023 in relation to the customs laws. To start off, the first amendment is the proposed insertion of the second proviso to Clause 4A of Section 25, by which the validity period of conditional exemptions has been clarified. For a background, in 2021, Clause 4A was introduced to restrict the validity of all conditional exemptions to 2 years with an objective of eliminating outdated exemptions. However, this amendment created a doubt amongst the taxpayers as to whether certain benefits available under FTAs, FTPs, and other bilateral and multilateral treaties can unilaterally be withdrawn by enforcing such a sunset clause. Although position in this regard was clarified through a TRU, the legislative backing to this clarification was absent. It is now being brought in by this proposed amendment. Here, there are two interesting points which ought to be noted. That one, that in case the finance bill does not receive the presidential assent by the coming 31st March, the sunset clause would trigger unless all the notifications are otherwise amended to individually prescribe an extended time limit. Second, that an ambiguity may be created for such exemption notifications which exempt both BCD and IGST, given that the proposed amendment keeps IGST exemption outside the scope of applicability of the sunset clause. Hence, it remains to be seen whether IGST would continue to be exempt even when BCD exemption such goods has expired. Coming to the second amendment which has been proposed, a statutory time limit of 9 months for disposal of application before Settlement Commission is reintroduced in Section 127C. As per the proposal, if the Settlement Commission fails to pass an order within the stipulated time period, the proceedings shall abate and adjudication proceedings would continue as if no application was made. What is critical to note here is that the prescription of a time limit is not a new concept, and even this time limit existed earlier until it was omitted in Finance Act 2015. This reintroduction of the timeline may resurface the debate as to whether an applicant can be subjected to an adjudication proceeding where the delay to dispose of the application is on part of the Settlement Commission. Coming to the last amendment, that is in the Customs Tariff Act. Here the Section 9, 9A and 9C have been amended. These provisions primarily deal with anti-dumping duty, countervailing duties, and the appeal procedure in case of trade remedial investigations. Presently, India follows a two-tier procedure for levy of duties, wherein the DGTR conducts an investigation, makes a recommendation to the central government for levy of duty, and thereafter a duty is levied. Basis this recommendation, the MOF may decide to either levy or not levy a duty. Recently, in a few investigations, the MOF has decided not to accept the DGTR recommendations on imposition of duties. Aggrieved by this, the domestic producers have approached various tribunals and other courts against the MOF decisions, but the key question in law under consideration is whether or not an appeal can lie against such a decision of MOF. The tribunal, in a few cases, has affirmatively held that an appeal can lie against the MOF decision, as it is indeed an order of determination. In a few of these cases, it is also noted that although the MOF is not duty bound to follow the DGTR recommendation, it exercises a quasi-judicial function in such cases and is required to offer reasons for non-imposition of recommended duty. This amendment proposed herein are just to clarify that the central government makes no determination of dumping, injury, or causal link, and that appeals under 9C can only be preferred against the DGTR recommendation. The bill also proposes that the amendments are to be retrospectively applicable with effect from 1st Jan 1995, which appears to be a way to negate the issue pending before the courts. The amendments, if brought in force, are expected to have major implications on all matters that have already been decided or are pending on this issue. Depending on the outcomes in these cases, at least at the present stage, it appears that the aggrieved domestic industry may only be left with one choice, and that is to approach the DGTR by filing a fresh petition.
Thank you, Akanksha. That was very elucidating. In fact, particularly the restatement of the timeline for Settlement Commission, it will be seen whether that has been adhered to. The second comforting amendment which you spoke about is regarding that there is no timeline as far as FTAs and FTPs are concerned, because if that would have been the case, it would have led to a lot of discomfort and chaos. The third issue, which is prescribing the procedure as far as trade remedial investigations are concerned and the role of MOF is concerned, that I believe is going to see a lot of litigation in coming times. Thank you.